Hi everyone, thanks so much for joining us yet again this year. Had a lot of great webinars, and this one will also be a fantastic one, I'm sure. We're talking about our global 2026 Outlook report that you no doubt you'll all be able to read. We'll certainly send out the link either in the chat here or after the webinar. But we're very lucky to have Daniel Needham here, our Global Head of Wealth and Research and Investments. And Daniel and I are going to be giving a few highlights from the global outlook, and we'd welcome any of your questions throughout as well. Just starting with a bit of housekeeping, you'll get some CPD points, and we'll email those out to you in about a week's time. As I said, please reach out and ask any questions as Daniel and I are talking. It always makes it much more engaging if we've got some great questions coming through. And you can do that through the Q&A box. We'll be tracking that throughout. We're recording the session. We'll send it out to you. And of course, as always, please provide your feedback after the webinar. We have our obligatory disclaimer here. Basically, anything that Daniel and I say you can't hold Morningstar responsible for, but that's the basis of that. I'm sure it'll be high quality discussion though. So just to give you a bit of a sense of what we're going to be talking about and what's in the outlook. You know, it's a global outlook. We're going to tailor it a little bit to, our positioning here for the conversation today. And it is a long document, so we're just going to cover off a few key themes that we think you'll all be interested in today. We're going to talk about the AI arms race. We're going to talk about the US dollar and how maybe it's at a turning point there. And also just if obviously the Magnificent Seven tech stocks have done very well over the last few years, where are we positioned? Where do we think you can generate some great long-term risk-adjusted returns? So we're going to talk about beyond the Magnificent Seven as well. So let's get into it. Maybe I'll give a bit of an overview, and then we can get into a bit of a conversation, Daniel.
Sounds good.
So what we've seen over the last few years and what's projected is that, some of these big tech companies, the hyperscalers as they're now called, the Microsofts, the Amazons, the Googles, the Metas, or Alphabet, I should say these days, they have, gone from really, net positive cash flows to spending a lot of, and probably still net positive cash flows, sorry, but they've spent a lot of money on CapEx. They've been growing their CapEx to invest in, this AI infrastructure. The concept of buying lots of semiconductors from NVIDIA, building out big data centers, all of this sort of stuff. And you can see in this chart just how little CapEx they were spending, back towards over the last 10 years, and how that's really ramped up and is expected to continue to ramp up between 25 and 29. I don't know whether you want to add any thoughts here, Daniel.
Yeah, well, hello everybody. It's great to be back down in Australia and participating in a webinar. I think that, as Matt pointed out, the capital expenditure of these large tech companies, hyperscalers, whatever you want to call them, has significantly expanded and is forecast, according to their forecast, to continue to expand. I think historically what we've seen with these businesses is they were capital light businesses that had very high free cash flow generation and were really had strong competitive advantages in their core businesses. And this is really changing now in the sense that they're investing way more. So they've gone from capital light to capital intensive. The valuations of these companies really has not reflected this shift in capital intensity. Effectively, it's implying that the CapEx that they're making is going to generate relatively high returns, requires really large amounts of recurring revenue, and at a relatively high margin. So this needs to work out really well. And they all need to be able to invest and make money on the back of it. And so historically, this is not been what we've seen. And so I think that if you look back through history, those companies that have had very large investment schedules have tended to underperform the market and not do well. And so, capital expenditure generally increases the amount of competition in an industry. It increases effectively the amount of cash flow that's going into those investments, and extra supply means that there's more competition. More competition means there's lower prices. Fixed costs need to be spread across a smaller amount of revenue as more companies are competing. So it just generally drives down returns. And so right now the market is pricing these businesses like they're not going to face any type of declining return from this activity. And so, we're certainly skeptical about that.
Yeah, what we're seeing, what this chart here is really showing you what Daniel's just describing is it's a bit of analysis that we've done in the global investment team. It's sorting into quintiles, into buckets, effectively. The lowest investment, companies that have had low investment intensity versus companies that have had high investment intensity, and their profitability. And what you can see is that the profitability, the returns that they're able to generate in a low intense investment environment has really been has outperformed those that are capital intensive over the last 60 years. This analysis has taken part of.
Yeah. And I think that there's an arms race on right now to be the first to AGI, artificial general intelligence. You've got these very large businesses that have historically dominated their marketplace in a kind of a winner-takes-all type situation. So Google Search, for example, Meta really owned social media. You've got these businesses that are used to that. And they're concerned that one of their competitors is going to own the artificial intelligence space. And so there's an arms race on getting compute so you can have the best models, so you can process data more quickly, so that if there is a winner, it's going to be them. Now, if it's a winner take all, there can be one, and there's more than one firm. So this creates this game theory type structure, a prisoner's dilemma, where if you don't do anything and somebody else wins, you can lose significantly. But if you all do something at the same time, you could almost guarantee there's going to be too much capital and too much competition. So in some ways, the rational thing to do for everybody is to not invest as much, but the rational thing to do in a sort of a game theory sense is everybody invests, and that's where we are. And so, and I think that, look, AI, all of the benefits of really, really fast and powerful compute is going to be significant. Corporate sector, individuals are likely to benefit. It's going to be a big productivity boost, most likely throughout the corporate sector. But just because it's going to be a benefit to humanity, especially some of the AI-related activities, doesn't mean the shareholders that are investing now are going to benefit from that. And history suggests that we've had these big investment booms that actually what's left behind is very positive for humanity and also for some companies that are able to be successful. But many of those companies that funded that, whether it's canals or railroads, fiber optic cable during the TMT or the tech bubble, many of those companies don't exist or aren't successful. So for us, that's the big question. And so we think it warrants caution for some of these companies that are priced at really high multiples, and people are assuming that they're going to be able to get very high returns on the capex. And so we think AI is positive for humanity and corporates in general. It might not be as positive if
for investors.
Yeah, exactly.
Especially from this point.
From this point, just because of the high multiples, even like a company like Nvidia, is a phenomenal company, but is priced to continue to be a phenomenal company forever.
Exactly. And maybe one of the questions, we don't have this question, but one of the questions I often get is, the circularity of this whole industry at the moment. What are your views on that? And, I guess maybe the capital cycle kind of concept as well.
Yeah, I think that, there's worrying signs now where you've got supplier financing, circular financing. A lot of this is being shifted from free cash flow, using operating cash flow to finance, to using debt. And so, I think that it's just another warning sign that maybe things are a little stretched in from a capex perspective. And I think that schedule that we see there, I think it's my personal view, and I think Matt probably concurs, is I think it's unlikely we actually see that schedule. Because I think reality maybe sets in before 2029 that there isn't going to be the level of returns available to everybody. And I think we've already started to see early signs of that. So, but there's already been a huge amount of capex.
And I think it's capex that, for the most part, they've been able to fund with cash and cash flow, but they are starting to take on leverage now as well, some of these.
That's right. And just one final point, I think the fiber optic cable that was built in the late 90s, has been useful for decades. Effectively, they were early, but a lot of the things that were underlying the thesis of all that build out, video chat, being able to share watch movies online, be able to share huge documents. All that's come to pass, but it took 25 years or 20 years. We're talking about investment in GPUs, so graphics processing units, like chips that have a useful life of 3 to 5 years. So this is a different build out. This is not a canal or a railroad or fiber optic cable. This is something that's going to depreciate quickly. Obviously, the data centers and compute centers will be there, but there's a lot of money being spent on inputs that are not long-lived assets. And so that adds a wrinkle to this that we haven't seen before.
Very interesting. There is a great kind of graphic in the Outlook that you should look at where I think Meta's Hyperion data center basically takes up the whole of downtown Manhattan. That's how big it is. So
yeah, that's right.
It's well worth having a look at. So if we're not investing or heavily investing in AI, certainly we have some positions in our portfolios that are taking advantage of the AI theme. But if we're not kind of all in that sector, where are we invested? That's kind of what we're going to talk a little bit about now. And I guess one of the things that people hear, and it's not just a case in the US, but certainly in Australia with a stock like CBA, there's lots of concentration there. We're used to concentration in markets in Australia with the banks and miners, but this is a bit of an unusual period for US stocks and global stocks from a concentration market capitalization perspective, and the US market is now the 10 largest stocks, as it says on the screen here, as you can see in the red chart, the red line here, is really making up 35% of the US equity market. That's bigger than the dot-com bust or even the global financial crisis. And so, Daniel, what are your thoughts on concentration, as it were?
Yeah, I think that markets will always tend to concentration. So the distribution of wealth or populations or cities is generally a Pareto distribution. So a small percentage of population of the data set will represent a large share of the output market. But so it's normal that you could get concentration. This is a very, very large level of concentration, and I think that it's been successive positive surprises for these companies. And then the market is effectively pricing as if there's going to be continued positive surprises. And so it's unusual. I think that normally it's a warning sign, concentration at that level. It's not a timing signal.
No, not at all.
It doesn't say, well, 35 is the number, but it certainly is a worrying sign. And so,
I think, if the fundamentals support a really concentrated market, then it's fine.
That's right.
But we're kind of... It is certainly a warning sign. Fundamentals may not be there, as we discuss. So, and there's a couple of, as we said, warning signs. We saw pretty big sell-offs after the dot-com bubble. The global financial crisis, obviously, a very large sell-off as well. But there were parts of the market that were attractive in both of those sell-offs that protected investors to some extent, where better valuations could be found, and actually with a starting point for some pretty good long-term returns dropping out of that part of the market. And so where we see that, maybe I'll set up this chart, and I'm sure many of you that are invested with us have seen it before, but these are our expected returns. It's a small subset of our Australian opportunity set, but some of the key areas where our expected returns are. I say to everyone that if you're expecting the exact number on this chart, then that we're not going to deliver that, but it's a really good guide of the relativities of the opportunities that we have in our portfolios and that we see over the next little while. So you can see that Brazil right over on the left-hand side of the chart is our expected return over the next 10 years of about 9% per annum, versus Aussie banks right down Aussie financials right down the left-hand side of the chart. We're thinking going to get a much less return there, a bit less than 2% over the next 10 years. So that's how you should be reading this chart. And the way that we use it, as I said, is really as a signal of where to start looking for investments and where the relativities might be. So at face value, what this is showing us is that emerging markets, Brazil, China, although China's come off a little bit, Mexico. These are areas that we think are quite attractive. The UK from a developed market perspective, and even Germany, other sectors like US healthcare and US consumer staples are reasonable opportunities. Australia right in the middle there. And if you were to look at our portfolio, it would be aligned to lots of these positions. So any thoughts just in terms of the high level here?
I think that we're global investors. We look everywhere for opportunities. And if you have a good framework and you're constantly looking, you always find relatively attractive opportunities. And so when you have a big popular theme, that can really suck a lot of capital in, a lot of focus in. And so that means that there's not as much capital flowing in to other markets, or maybe, if there's a negative outcome for an unpopular industry, it really sells off. And so, so the flip side of, concentrated market and a big popular theme like AI means it can really create a lot of opportunities elsewhere. Often, they're going to be businesses or industries or countries that are maybe they've had some short-term challenges, but maybe the market is overreacting to that and not focused on it. And so that's where we can do our best work. You have to be willing to look a little different at times, and I think you'll see that within our portfolios. But I feel like there's despite some pockets of relatively overpriced companies and segments of the market, there is still a pretty rich opportunity set, and we're always working pretty hard to find it.
Yeah, so something that's coming into our portfolios now is a healthcare theme. We've been building also a bit of a position in our Aussie portfolios across the consumer sector, and really what that's based around is there's been a lot of issues for consumer-facing products over the last few years, consumer stocks. The cost of living pressures, affordability has really hit stocks over the last couple of years. Since 2022, consumer names. There's obviously been China, the slowdown in China. That's been a real big drag on, in particular, luxury names. And of course, more recently, tariffs and tariff impact and the effect that's going to have on some of these consumer names. If Nike's a good example of being a producer in producing a lot of its product in Vietnam. For example, that's been it's had tariffs put on it, and so a lot of pressure has come onto these, lots of the names that you see on the slide here. But actually, if you think about it, slight turnaround in any of these things is going to lead to potentially outsized returns. And so you just need to see a little bit of a recovery in the Chinese economy and the consumer starting to spend there to start to potentially get some of the tailwinds around the luxury brands. That's one catalyst. Obviously, people getting more comfortable with tariffs and the impact that they're going to have, and the cost of living. If inflation is at a lower base, and even if it is a bit sticky around those higher levels than we saw in the 2010s, potentially people can get comfortable with that, and the cost of living pressures ease. So there's a range of catalysts for these stocks to do really well. That's kind of what we like in when we're building out positions in these kind of names. But what are your thoughts, Daniel, in this sector?
Yeah, I think that what you have are businesses that have had relatively strong history of delivering returns for shareholders. Have had strong competitive positions. You've had a couple of, whether it's idiosyncratic challenges like Estee Lauder. You've got business like Pepsi, which has really beaten Coke for 20 years, and then all of a sudden it's had some challenges with its snacks business. But these are well-run businesses with talented management, strong competitive positions that have faced temporary challenges that we think will effectively be improved, or the market's certainly pricing more negative outcomes. These are great opportunities. Like when you can buy great businesses or good businesses at low prices, it's often because there are challenges. And so I think the opportunity set here is quite attractive. Consumer cyclicals, even businesses like BMW and VW, which are very capital intensive. They're priced at points now where it's implying they're not going to make returns for the next 10 or 20 years. So it's attractive. I think there's always going to be these bottom-up opportunities that get left behind. But there's a reason why they're trading at low prices. They've had issues, they've had challenges, and our fundamental analysis allows us to sort of separate those businesses out and say, well, yeah, sure, it's a challenge, but we think it's going to be able to be dealt with by management. Yep. And the benefit of buying businesses at discounts is that the price already includes a lot of negative outcomes. So you don't need great outcomes. You just need things to be less negative, and you can get a good return. And so that's kind of the thesis here.
Yeah. It certainly. Now, before we move on, we do have a couple of questions that might be relevant to this section. Firstly, more depth on why we think Brazil is, going to be a great performer over the next 10 years. I think that I'll maybe have a go and then hand it over to you. But I mean, just in terms of our expected returns, this is a starting point for our analysis, just to be clear. It's not really including a full fundamental analysis, just to be clear. That aside, we do think that Brazil is a really good opportunity. It's got lots of, very high quality banks, miners, very similar to the Australian market in terms of market structure, but they're at much more discounted prices than Australia. So if you can get comfortable with some of the geopolitical risks around Brazil, then you can own really high quality banks and miners at a much more discounted price to what you can own Australian banks and miners, just at a most simplistic level.
That's right. When we roll it up, effectively what this represents is that in aggregate, the companies in Brazil are trading on lower prices than you would expect relative to the fundamentals. On a forward-looking basis, when we look at the underlying companies that are there, you're as Matt said, concentrated banking system, some really high quality, like Ambev, really high quality beer producer, very dominant market share. As we go through the bottom up companies, you just find market leaders, especially not just in Brazil, but in South America. So when you look at the return on invested capital, you look at the margins, you look at the growth upside, and you compare that to if it was listed in the US or listed in Hong Kong or Singapore, it'd be trading on much higher multiples. And so we think there's more upside there.
Yep.
But, as with all of our investment opportunities, when we're investing, it's often because other people are more concerned about macro issues or bigger picture issues. There's been some challenges. There's been some political uncertainty in Brazil. There's been some challenges with some of the bigger companies, the big Petrobras and Vale. And so, but overall, looking out 10 years, we think that the fundamental picture there is likely to improve, and you are not paying for that right now.
Yeah. And the other question we had was just why India isn't on the list of opportunities. India, this is a short list of opportunities. It's not certainly India is in our opportunity set. I guess if we were to look at it, even though India's come off a little bit this year in terms of its market, we still think it's quite overvalued at this point in time. And if it was to become a better opportunity from a valuation perspective, we'd bring it into our portfolios. Yeah, I guess there's one more issue with India, and it's a little bit hard to access that market as an Australian investor and in a cost-effective way. But that it's certainly within the broader opportunity set. Yeah. So if we move on to the next section, I guess over the last 10 years, but certainly even longer than that, the US dollar has been there's been this concept of flight to quality, and part of that has been the US dollar, US treasuries as well, I guess, in terms of flight to quality in times of market stress. And we've seen that a lot. It's been a pretty consistent theme over a very long period of time. If we went back even further than what you can see on the left-hand side chart here, back through the global financial crisis or even beyond, US dollar has been somewhere where people have investors have flocked to whenever there's been a period of market stress. And that's been even more acute for us here in Australia as Aussie dollar investors. The Aussie dollar has been seen as much more a growth currency, and so when things are going well, people move into the Aussie dollar, but in times of stress they certainly move even further away from the Aussie dollar. So holding US dollars, I guess, to simplify what I'm saying, has been a good diversifier in portfolios. And I guess what we're saying in this chart, or the chart on the left at least, is that perhaps that didn't work as effectively as it has in the past, just in the April sell-off. The Aussie dollar did sell off for a very brief period, but then we saw a lot of Aussie dollar strength and actually strength across the board in non-USD currencies. Now, Whether that continues or not, whether we see kind of the Aussie dollar still selling off in those risk-off environments, we believe that it probably still the US dollar still has some defensive characteristics to it. But certainly over this little period that we've seen, the US dollar hasn't been as strong. Now, if we look at just where we see valuations of currencies, before I get Daniel's views, what this chart is showing us is that we think that the US dollar is a little bit unattractive. It's the blue line down the bottom of the chart there, where it's not at an extreme level, but it is unattractive relative to some of the other currencies. The pound and the euro, they're much a muchness. Emerging market currencies trade pretty, or over the last 10 or so, 5 to 10 years have traded pretty much in line with the Aussie dollar. I guess the standout opportunity relative to the Aussie dollar that we can see at the moment that also has some defensive characteristics is the yen, which we think is quite attractive at this point in time. But maybe hand over to you, Daniel, to get your thoughts on the currency markets and how they can help with diversification or not.
Yeah, I think that what currencies are an interesting area to research because they're a relative price. They're not, if you think about it from a fair value perspective, you can have spread the relative cash spreads in the forward market that needs to price, that can have a fair value. But generally, it's a relative price, and so there isn't a really firm anchor that brings it back. It's hard to arbitrage currency. So what tends to happen is currencies tend to trend. They can stay overvalued for a long time. They can stay undervalued for a long time relative to using a relative purchasing power parity approach based off the tradable goods sector and some other adjustments. So it's not a really good timing signal necessarily, but it can be useful when you're thinking about sort of a reward for risk range. And historically, what we've seen is that the US dollar has provided a bit of a flight to quality. And what we saw in this recent sell-off was, there was a flight from the US dollar assets. We saw all US dollar assets go down across the board, and that just highlights that these relationships are not. You can't set your watch to them. You have to recognize that these relationships can break down. I think when a currency is overpriced and it's based off really strong relative fundamentals, it can be more exposed to a breakdown in the sort of correlation structure. And so we think that the US dollars, for an Australian dollar investor, it's probably not going to maybe not be as reliable as it has been historically. And we think that over time you're probably going to see the Australian dollar appreciate relative to the US dollar slowly. But I don't think things aren't crazily extreme, and so it's an area where it's useful to do the analysis from a portfolio construction perspective. But it's very periodic that you can get really big investment opportunities, like we had when the Australian dollar was at 110, and we were very, very short. And
I think that's right. When currencies get to extremes, then maybe there are more actually opportunities to generate outsized returns. But as you say, they're useful, on an ongoing basis as from a portfolio construction perspective, especially for an Aussie dollar investor, where
that's right.
It has some of these tendencies to sell off in risk-off markets. Now we're nearly approaching time. Happy to answer any more questions that might come through, so feel free to send them through. But I mean, one of the key themes in the outlook is really making sure that everyone's, or your investors, your clients are prepared for what could the potential outcomes in the market, and most importantly, not overreacting when you get those news headlines like we saw in Liberation Day, or if the AI, I'm going to say bubble bursts. If it does burst, then there's going to be sell-off. There's going to be lots of news headlines. Looking through that noise is really important. So I might, there's a few things that we can do, and that you can encourage. I'm sure you do encourage your clients to do. But certainly, we want to play our part managing portfolios that are within the expectations of you and your clients. So Daniel, do you want to talk?
Yeah, I think for us, the headlines, the market volatility, the uncertainty, these are regular occurrences in markets. And so if you open the newspaper, a decade ago or a year ago or 50 years ago, it's going to feel very uncertain, very risky. There's always going to be something that's on the headline that everybody should be super worried about. But historically, if you were thinking about the fundamental value of that asset and taking a long-term view and being sensible, trying not to overpay for assets, rebalancing your portfolio, taking advantage of the opportunities when they're at extremes, you tend to do very, very well. And so, and that's really the core of our approach. Market volatility presents opportunities. People overreact in a negative way. That really is where we get most of our investment opportunities. And when we're doing our fundamental analysis, we're just looking through the noise. We're thinking long term. Every asset you buy, the price should be dictated to by the cash flows that are going to be thrown off between now and Judgment Day. And so, whilst there's a lot of talk of the market being super efficient and getting more and more efficient, that may be the case in certain areas of the market. But we think we continue to see periodic dislocations, but they're not always in the same place. The opportunities move around, and so that's why it's important to be opportunistic, and that's why we really try to scan the market. And we're willing to look different at times when the reward for risk is there. And we manage portfolios for our clients as we would our own portfolios, which is we don't want to lose money we can't make back. And
Exactly.
and so, but the opportunity set, I think, is just as rich as it often is. You've just got to really do the work and scan across.
There's no easy singles out there, really, but, but you've got to do the work.
I think you've got to be patient and have the ability to take advantage of the opportunities when they present themselves. And I think that's why it pays to be, disciplined and patient. And, Warren Buffett says, he talked about the market. He's retired now, I guess, at the end of the year. So, the beautiful thing about investing, it's different to baseball in the sense that you can be at the mound, you can be there with a bat, and you get to look at every pitch, and you can't get called for strikes. You can just watch everything go by. You don't have to swing at anything and wait for it to be in your sweet spot, and then you hit. And most people feel like they've got to swing at everything, and that's not how you do well over the long term. You're very selective, and when something is in the sweet spot, you take advantage of it, and at times you invest very aggressively. And so that's our approach, and we think it's going to work in the future. It's not going to work every time, but this current AI investment boom feels like it could be yielding some really attractive opportunities for us in the future.
Yeah, indeed. Now there is one question, I was waiting for it, on gold. I'm going to get Daniel to answer it.
That's cool.
And then we'll probably wrap up. There's a few comments just around questions about the report. We'll make sure everyone gets access to the report after this webinar.
Yeah, gold's a tricky one. It kind of fits into the commodity sort of currency type bucket. It's really a commodity, but it's also performed a quasi sort of currency role because of history, the gold standard, Bretton Woods. And so, there's no doubt it has utility as a commodity. It's used in a lot of production. It's got tight supply constraints. So there's not a huge amount of gold that gets mined every year. There's not a huge amount of gold above ground. It's historically been viewed as a store of value. So it creates this kind of, attractive alternative to cash, to bonds, to other investments. But historically, it hasn't been a very good performing asset class relative to inflation. And so, because it's a relatively it's got a relatively small market value relative to treasury bonds or public equities, it can get, when it gets popular, the price can rise quite a lot. And I think we're in a period right now where gold, the price has risen quite a lot. We don't think you can value it. Currencies, you can use a relative PPP because there's an economic linkage there, the law of one price. Gold doesn't have that. It doesn't throw cash off. So it's always hard to work out I don't think it's possible to work out what the fair value of gold is. So it's a speculative asset. But, there are times where, it could be a useful thing to have in the portfolio if all the stars line up. But we don't have a view on gold. Right now, if you put a gun to my head, I would say if you had a value, it would be very overpriced. But to add it to the portfolio, we would need to have more than just the price. We'd have to have a very strong fundamental view about the supply of gold being very, very constrained, the price in real terms being very, very low, interest rates being very, very low. So the opportunity cost for holding gold is very low. I don't think that we're in any of those situations right now. So, so I think I ducked it a little, but.
So thank you very much, everyone, for joining today. As I said, we will make sure that you do get the report. We'll send it out, a link to it out, hopefully a link that works after this webinar. And really, as I say, thanks to Daniel for joining while you're out here.
Great to be here.
Safe travels back to the US, and Thanks again, everyone, for joining.
Great. Thanks very much.
See you next time.
Cheers.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.